President Donald Trump's first 100 days in office is seemingly making news by the minute. There's certainly no shortage of busy things in the world of economics to talk about. Here, join us now to help us unpack some of the economic implications we've seen over the last few months is Greg Ip. He's chief economics commentator for the Wall Street Journal. Greg, really grateful for your time. How do you diagnose the current state of the Trump economy today, given the tariff uncertainty and how markets have been responding specifically since April 2nd?
Well, JD, that question depends entirely on how you look at the state of the economy, whether you look at the hard data, things like GDP and employment, or whether you look at more soft data, things like market sentiment and confidence surveys. You get two very different answers. When I look at the hard data, like consumer spending and payroll growth, the economy under Trump looks a lot like the economy under Biden. Almost no distinction whatsoever. Pretty solid spending, pretty solid payroll growth. You can see little hints of things here and there. For example, federal payrolls are down. That's no doubt the effect of Elon Musk and Doge. We've seen a very big surge in imports. That seems to be companies that are trying to get ahead of Trump's tariffs. But again, when you go beyond that, not a lot going on in the overall economy. But then you do see these signs of people being very anxious and worried. Confidence surveys show that people are very worried about their future, about the future. Businesses extremely concerned about the impact on them of higher prices and so forth. And the stock market, as you mentioned, like down a lot and now up a lot, based entirely on where they think the president is going on his tariff plans.
Consumer confidence shapes consumer behavior. Is it too early to tell yet the changes in consumer behavior, whether it's spending or saving or how the average American might be engaging with their money, given the increased skepticism for the road ahead?
It really is too soon. I mean, in fact, within these surveys, it's interesting. You'll often see that they divide the questions into two parts. The first question is, how do you think things are going right now? And how do you think they're going in the future? And predominantly, you find that people say things are going fine right now, but I'm extremely worried about the future. And it tends to be their assessment of how things are going now that affects their spending. We do see that certain things are weak. Housing is weak, but that's in some sense a holdover from the last year, and that's primarily because mortgage rates continue to be high. And we see some strength in automobile sales, which might be people trying to buy that imported car before the price goes up because of a tariff. But I think that we're going to have to see more material impact on actual prices before the tariff stuff actually begins to affect behavior.
What are we seeing out of small and medium-sized businesses? And is there evidence yet that we're seeing a separation between the haves and the have-nots, Greg, where the bigger institutions, the bigger companies can maybe withstand some of this general uncertainty better than smaller companies, especially given the fact that despite all of this, we're still in a relatively high interest rate environment?
There is a little bit of a sign of that. You do see surveys of small businesses where there's a great deal of concern, and we hear anecdotally companies tell us that, I need to find a ton of money to pay these tariffs up front when I bring my goods in through the a port, and those cash flow pressures are very real. Big companies obviously have much more resources, ability to turn to lines of credit and other things like that. Plus, fairly wide price margins if they need to absorb some of those tariffs. But again, the stress you see on small business has not aggregated up to the level yet where it's causing them to pull the plug on hiring and so forth. I think that the time to look for that would be in the next 3 or 4 weeks as these tariffs start to bite. And that, by the way, is assuming that there aren't yet more changes to the tariff policy, which is, a pretty sort of fragile assumption.
I mean, a lot of people have been inclined to say wait 5 minutes because the news may change just that quickly. Greg, I'm sure you are like so many of us. We look at ISM manufacturing data. We look at CPI and PPI prints, PCE, every imaginable acronym month to month. Not to mention what you indicated a bit earlier, the University of Michigan consumer sentiment surveys. I wonder, are there particular points of data that you are looking at most closely to give you a bit of confidence to know what the road ahead looks like? What are you tracking most closely?
On the labor market side, I look most closely at the weekly data on how many people are making a first claim for unemployment insurance. It's pretty timely stuff. It's reliable. It's got the government imprimatur. Again, not telling us that there's much going on in layoff land. There are surveys done by Indeed, an online job site, that tells us about vacancy activity. That's sort of interesting. I'm a big believer in looking at the stock market. That's a lot of people with money on the line making decisions in real time. And the fact that the market has come back quite a lot in the last 3 or 4 weeks, I think, is fairly important. And finally, there are a number of organizations, ourselves included, that have sort of set up web scraping tools to try and look for any sign on the online pricing systems that these tariffs are starting to affect prices. And there are a few signs out there that, yes, they are starting to feed through. Nothing too dramatic yet, but there are signs that it is starting to happen.
That is a really fascinating last one. I'd be interested in knowing more about that. But of course, the week you and I are having this conversation, we are expecting another decision from the FOMC with regards to the short-term fate, or the fate, I should say, of short-term interest rates. What do you make of the push and pull right now between Chairman Powell and President Trump?
Well, Powell right now is in sort of the same situation we all are, looking at an economy that, based on the actual data, seems actually pretty darn good. Reasonably strong employment growth, reasonably strong consumer spending, and inflation pressures that are continuing to moderate bit by bit, which is exactly what the Fed expected when it began to lower interest rates last September. But of course, the future is a different matter. And here they're really in kind of a bind, right? Because we know that tariffs have two offsetting impacts. One is that they sap disposable income and they weaken spending and confidence, and that would normally be the kind of environment that calls for lower interest rates. But they also raise prices and add to inflation pressure, which normally leads to higher interest rates. So the challenge for the Fed really in the months ahead is to watch the data come in and decide which of those two factors is the more important one. Right now, the markets think that the weakness of the economy will be the overriding factor determining what the Fed does. They're expecting that not this week, but in the months ahead, the Fed will start to see a case for lowering interest rates. I guess we'll get to hear more straight from the Fed chairman's mouth exactly what he's thinking and whether those are valid expectations.
Greg, do you look at things like the weakening of the dollar or the drop in oil markets as silver linings, or are there components of those movements that concern you?
Both of those are telling us it's interesting but slightly different stories. So there's two factors why oil is down. Number one, because of the tariff war, the world economists and investors think that the global economy will be weaker this year. A global economy means less demand for oil, so the prices drop. But the other factor is that OPEC Plus has actually announced several surprise increases in supply, and that's helping bring oil prices down. And that's kind of good news for the U.S. consumer because it acts like a little bit of a tax cut, right? You're going to have, and given that they'll probably be spending more on goods because of tariffs in coming quarters, it's probably a nice little cushion that they'll be spending a little bit less on gasoline. Now, the dollar is another interesting story, and it's a bit of a puzzle, to be honest, because given the overall outlook for the economy this year, most people thought that the dollar should have strengthened. Interest rates staying high, Trump's tax cuts coming along, weaker foreign trading partners, so their currencies would fall against the dollar, and instead the dollar has dropped. It's nothing like a panic. It's nothing like, an emerging markets type crisis yet. But I think one thing it's telling us a little bit is that the enthusiasm for America, the so-called American exceptionalism trade that we were all talking about a year ago, that's kind of dissipated. People have sort of lost their enthusiasm for investing in the United States, partly because of the somewhat antagonistic and unpredictable approach to foreign and economic policy by the Trump administration. I think there's been a slow leak of foreigners trying to move their money out of the United States, and that's what the weaker dollar is telling us.
Greg, it was a fascinating conversation. I hope you will consider rejoining us again, because I think this is really important context to make all of us a little bit smarter to better understand the moment that we're in. Thanks a lot for being here. Greg Gitt, Chief Economics Commentator for the Wall Street Journal. Greg, thank you.
By all means, thanks for having me.